Hi there! In this video, we are going to talk about how to decide what shares to buy if our investing strategy is value investing. But first, let's have a look at what value investing is and why many successful investors consider it to be the best long-term investing strategy. Value investing is exactly what it sounds like, a strategy for investors to buy cheap shares. Here, we must understand that the market price of a share is not equal to its value. The price is the result between the supply and demand on the market, while the value of the share is its true intrinsic value. So, if we know the true value of a share, we can save a lot of money when we buy it undervalued. Many successful investors use this strategy with great returns, up to 15% per year. But the question is, how do we know if a share is undervalued? I know the idea of analyzing all the financials of a company could be overwhelming. And to make it even worse, if we Google information about value investing, it would be even more discouraging. We will find out it is a risky strategy. It implies a lot of effort and research for stock selection, and also the recommendation to consult an expert or to invest in mutual funds or popular indexes to attenuate the risks. All those things might be true, but doing so, in the end, our return will be very little, not enough even to exceed the inflation rate. On the other hand, some experienced investors using value investing strategy say that we don't have to be a genius to use this strategy, and it is for everyone, regardless of age, wealth, IQ, or social status. Used properly, we never have to worry about money again. But we have to learn how to perform some basic calculations. And most importantly, we don't need to identify 1,000 of good investments. All we need is a handful of great ones. But before any calculations, first we have to go through 4 steps. Firstly, we have to find businesses that have meaning to us. Having stocks in a company, everyone knows it means that we have a piece of ownership in that company. In order to be successful, we want to invest in a business that we understand enough to want to own the whole of it if we could, and that business has to reflect our values. Acting in harmony with who we are means investing in harmony with who we are. So, before any calculation, we have to identify what kind of business we understand. After we found out what kind of business is meaningful to us and we are willing to invest in, we have to investigate if its future is predictable. Obviously, we want to invest in a company that will grow for decades, but only if we can predict with a high degree of certainty that it will grow. We don't want to invest in a company with an uncertain future. In other words, we are looking for a business that has a competitive advantage. Finding a business with a wide moat is the key. To put it simple, if an industry looks as it might be very easy to get into, there probably isn't a moat. On the other hand, if it looks as it might be really hard to get into and to be successful, it is probably a wide moat business. The third step, after we identify the business and the moat, we have to investigate if the business that we want to invest in has a great management. Most professionals, in order to conduct the equity research, look at things like the earnings growth, return on equity, competitive position, and so on, but they ignore or pay very little attention to the quality of people running the business. In fact, both factors matter equally. A business does well when the management running the business consistently does great work for the company and also for the investors. The CEO must be motivated, realistic, transparent, and honest. The management is responsible for the strategic decisions, for creating value for shareholders, and to run the company in the interest of the shareholders. But let's face it, managers are human beings, and it is practically impossible they will think only about the shareholders and not for personal gain. The problem arises when managers' interest differs from that of the shareholders, and that is what we are trying to find out. To analyze the company's management is difficult. There is no formula for doing so, but we can follow some guidelines. The last step that we have to consider prior to value investing is to decide what margin of safety we want. Most of the value investors practice a margin of safety of 50%, which means if, for example, the intrinsic value of a share is $100, we will buy this share only at the price of $50. In other words, we would be able to buy this share deeply discounted and we can sell it later without losing money, even if we were wrong in the first place. And now we have to know how to calculate the real value of a share, which means a combination of financial analysis such as revenue, earnings, cash flow, profit, to see the financial health of the company. How to do all these calculations is the purpose of this channel, so if you want to learn how to know the real value of a stock, subscribe to the channel and hit the notification button. In this way you won't miss any video. To sum up what we discuss in this video, we can say that if you want to invest our money based on value investing strategy, firstly we have to find a wonderful company. The word wonderful actually covers 4 elements. The company has meaning to us, it has a white moat, a great management, and we buy the shares only at an attractive price, which means a big margin of safety. I hope you enjoyed the video. If so, don't forget to hit the like button and see you in 2 weeks' time with a video about how we identify the business that we understand and it is meaningful for us. Thank you so much for watching and stay tuned.